Welcome to FX Options University, recorded live at the International Securities Exchange, the world's largest equity options exchange. Join the industry's top trading professionals as they provide insight and strategies for trading in the currency markets using FX options. FX options are a low-risk alternative to hedging currency moves in any market condition.
Welcome, everyone. This is Steve Meisinger, your host for today's ISC webinar. Today I'm really pleased that we have Jack Crooks with us. He's the president of Black Swan Capital. Jack has tremendous insight into the currency markets. I learn so much from Jack each and every week. If you subscribe to the Currency Currents Professional, which, again, everyone has to make their own decision on this, but I think it's very valuable personally. But, again, you have to make your own decision. You can learn tremendous insights into the currency markets, and you could go to Black Swan Capital, blackswantrading.com, and learn more about the Currency Currents Professionals. But without further ado, I want to introduce Jack Crooks. Jack, thanks for joining us today. Really appreciate it.
Thanks, Steve. Thanks for having me. Thanks for that nice introduction. Always appreciate it.
You're welcome.
Just going to talk today, and I wasn't quite sure really where to go with this subject, to be honest, this reserve diversification, this category. We could really get into a lot of nitty-gritty and do a lot of accounting stuff based on holdings of reserves across the various countries. I kind of took a little bit of a different tack, kind of make some general comments about just the general direction of reserves allocations, meaning just institutional or central banks holdings of currencies, and just a little bit on the trends. But want to move that into some of the areas of kind of really a global macro view and what will be the driver of this reserve diversification in the future. And I think most people, if you were to ask them, they would say that the U.S. dollar, of course, is in trouble. I just met a gentleman over the weekend, a very astute guy, and he found out that I was involved in the currency markets, and he says, don't you feel like everybody else feels that the U.S. dollar is going to go to zero? And that's, it's interesting that is the general feeling, and I think part of that feeling is because of the fact that when we look at our own economy, we see some very, very ugly things going on the fiscal side, on the monetary policy side, and we say it's just a disaster for the U.S. economy, train wreck, and coming at us, and therefore the dollar has to be hit. But again, that's not always the case when it comes to currency markets. It's a very perverse market, and what you always have to keep in mind, at least at this stage in our lives, is that the U.S. dollar is the world reserve currency, and precisely because of that, it gains many, many benefits, even though the U.S. Government, U.S. monetary policies have abused that responsibility in a big, big way over the last several years, many years, in fact, not just recent times. It's just recently it's been even worse than it has been in the past in terms of their abuse of monetary and fiscal policy. But the reality is the dollar will be here for a long time unless the monetary authorities, powers that be globally, get together and come up with some sweeping global monetary changes. Now, in the midst of the cycle we're in, where everybody's trying to save themselves, it's doubtful we're ever going to piece together anything that in the near term. So I think we're stuck with the system that we have. And let me get to it. With that introduction, it's based on one of our disclaimers, the secondary disclaimer. And as I said, let me just go through the rough key points here before I get into some of the global macro, and I'll try and get through this fairly quickly because it's a topic that can go a lot of different ways, and I just want to get your questions in case I didn't hit the mark on really what you were expecting in this webinar. But in terms of reserve diversifications, I guess this is what we consider the key points are. Number one, the dollar is still dominant, and I'll show you that from a chart standpoint, the percentage allocation of dollars relative to the other currencies. It's still clearly the global reserve currency by far, driving global trade. Dollar credit fuels all markets and asset markets globally. Number two, it's clear, and again, this is no surprise, a shift of power to the EM. EM stands for emerging markets. We're going to see the relative holding in the emerging market currencies increase. And that's generally going to start to squeeze out some of the lower valuations of these emerging market currencies. I have a chart in here showing how undervalued, in particular, the Asian bloc currencies are relative to the rest of the world. But as the power shifts to the emerging market, and it seems to be set in concrete, given all the opportunities, giving enhancement for yield, giving the potential for subpar growth in the industrialized world economies for many years to come, I think a lot of the money at the center, the main financial centers, will continue to shift out to the emerging markets for growth and yield, and which means the allocation of reserves to the emerging markets will increase, and it will decrease. The dollar relative holding will decrease accordingly. You're going to tend to see, I think, local blocks being set up, local trading blocks as China starts to free up its currency a bit more. You'll see some cross-border trade in the local currency in China with some of its trading partners and just totally bypass the dollar. As that starts to happen more and more, and you see these local exchanges, cross-border exchanges with the dollar out of the picture for things like commodities, which dollar dominates the trading of all global commodities, but that will start to change, I think. No doubt the U.S. dollar will lose some of its relative position in the world, but this is a slow, long-term process at the moment. And right now, even now, with relative power and growth in the emerging markets, their relative GDP growth in the world, their share of holding in terms of reserves is very, very small. And one of the primary reasons for that is they really don't have a very deep capital markets per se in the emerging markets. Unfortunately, the emerging markets still depend primarily on the deep markets in the West, of local liquidity in the West, money moving out from the center to the periphery being the emerging markets for funding. And that's one of the reasons the relative holding of emerging markets hasn't increased as a percentage of that much. But that will change as the capital markets start to form. When I say capital markets, what I'm thinking of primarily here is bond markets. You get depth of capital markets when you have bond markets, and the Asian markets don't have those with any significant depth at the moment, but that will change, I think. As the shift to emerging market, generally I think you're going to see it support the commodity currencies. The whole idea of globalization and cross-border demand for raw materials driven primarily from China, you're already seeing the percentage of the allocation towards the things like the Australian dollar and the Canadian dollar start to increase a bit, and just the relative level of global trading in foreign currencies, in the commodity currencies, has increased dramatically because of this shift in emerging market demand, and again, primarily with China at the center. Fourth point, China really is the wild card here. China could try and force its currency into the open market more. I think there's no doubt, in my mind, and I think others, that one day China wants to be the hegemon global power, taking over the position of the U.S. And to do that, of course, they're going to have a freely traded floating currency, assuming that's the system that's in place at the time China tries to take over that role. But at the moment, they're very, very far from that, and they still play the role as really exporter of choice, meaning they have not made that transition of a balanced global economy, and we're still relying on their export model. And precisely because of that, they haven't let their currency float, and they're continuing to suppress their currency. And in those terms, they aren't allowing. They're doing some experiments, finally letting some of their companies keep some money offshore. But up until just recently, most everything has to be funneled back into the People's Bank of China, so China can have complete control. That will likely slowly change. But the point is now that there's no reason at the moment for them to abandon the dollar. We hear these horror stories that, oh boy, China's reallocating reserves. They're running from the dollar. They're buying euro. They're buying Japanese yen. Well, they may be doing some of that at times, but there really is no place else for large capital to go, and we don't see that as a threat to the dollar's reserve status. And I'll get to that in just a second and show you some of the numbers.
Get trading ideas, exchange rates, webinars, news, and commentary. Visit www.fxoptions.com. ISE FX options can be easily traded through all options-enabled brokerage accounts. These exchange-listed securities are cash-settled in U.S. dollars and have a European-style exercise.